If you look at the big Wall Street firms, the investment strategists are now saying that gold's going to 5,000. Really, they're talking their book based on history. It's a giveaway. It's a way to get attention. And I can't speak to that. I would tell people that although I sold my physical silver last week, I haven't sold my physical gold. Most people don't own physical gold. There are other people who probably have less speculative alternatives than I. And for them, they probably shouldn't sell their silver. I believe that the silver price is going to go up from here. Make no mistake. I also believe that I have a competitive advantage in silver stocks, and that the silver stocks, the best of them, will exhibit more torque for silver. Because I've spent almost 60 years learning how to speculate in silver stocks, it makes perfect sense that I would sell my silver and buy silver stocks.
While major Wall Street firms are generating headlines with aggressive forecasts of gold hitting $5,000, seasoned speculators view these targets as broadly talking their book to capture public attention. However, beneath the hype lies a strategic shift for sophisticated investors who recognize that the most explosive gains in a precious metals bull market often come not from the bullion itself, but from the equities levered to the underlying price. Rickrule, president and CEO of Rule Investment Media, reveals that he has strategically liquidated his physical silver holdings while retaining his gold to rotate capital into silver mining stocks aggressively. With nearly 60 years of market experience, Rule emphasizes that the best of them will exhibit more torque, arguing that his competitive advantage lies in selecting equities that will vastly outperform the physical metal as the silver price climbs. Now, we present the clips from Rick Rule's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think now that there is generalist support in the gold and silver market. Nothing like you'll see in 3 or 4 years, but there is generalist support. When you and I first began to talk, Dunnigan, JP Morgan Chase suggested that precious metals market share as a percentage of all savings and investment assets combined in the United States was less than 0.5%, which would suggest that the generalist investor couldn't spell gold. If you look back over the last 6 months, never mind the ledger of Dunnigan Kaiser, bullion dealer, but rather you look at broader measures like the flow of funds into ETFs. For the last 6 months, the flow of funds into ETFs has been positive as opposed to negative, which is to say people have been adding. Maybe anecdotally more important is historically in bull markets, when the generalist investor comes in the space, the silver price begins to outpace the gold price. And we saw that changeover occur about 3 months ago. So I would suggest that we do have generalist participation, but we still don't have broad-based participation. Witness another factoid. If you look at the big Wall Street firms, the investment strategists are now saying that gold's going to 5,000. Really, they're talking their book based on history. It's a giveaway. It's a way to get attention. But their mining analysts are using $3,200 or $3,300 gold quotes in doing their earnings estimates. That will tell you something about the lack of favor that gold has even amongst mining analysts. And I can't speak to that. I would tell people that although I sold my physical silver last week, I haven't sold my physical gold. Most people don't own physical gold. It's not like most people have trading positions to trim because they don't have any positions whatsoever. How do you trim nothing, And I would urge people who are interested in this to play back some of the earlier interviews that you and I did about the arithmetic of America, about why I believe that the purchasing power of the U.S. dollar declines by 75% over 10 years. This isn't a number that I drew out of air. It's a number that, while not certain, is, I think, arithmetically sound. I think, too, that it's likely, but not certain, likely based on history, that the gold price mirrors, in nominal terms at least, the deterioration in the purchasing power of the U.S. dollar, suggesting roughly that gold will maintain its purchasing power across a broad basket of goods and services, while the dollar will lose 75% of its purchasing power over 10 years. Does that mean that 2026 is going to be as kind to gold holders as 2025? Unlikely, because you only make up for lost time once. Remember that gold was substantially underowned, substantially underpriced 2 years ago. It was that coiled spring that began to come unsprung. Future moves in the gold price are going to have to be earned by the deterioration of the purchasing power of the U.S. dollar. I would suggest that most of the tension in the spring has been released. in this dramatic move that we've seen. The circumstances that are in place today that are propelling gold and silver were in place in 2021 and 2022. But people's expectation of the future is set by their experience in the immediate past. So although the facts were laid out in front of them, they didn't have the courage to act. Gold and silver were coiled springs, and some of the tension has been taken out. It's as simple as that. Now, I need to say to people that most people require, even if they understand a narrative, price action to justify the narrative. And it's wild to see a circumstance where more people want to buy silver at 80 than did at 20. When the price moves from 20 to 80, understand that it is precisely 80% less attractive. That's just the way it works. The easy money is made when you buy based on hate. If there's a popularly held public pretense that's wrong and you bet against it, that's the easiest money financially you can make and the toughest money psychologically that you can make. I believe, Dunnigan, as you and I have discussed many times, that gold and silver continue higher, but probably at a less voracious pace. I believe it not because the price has gone up. That makes it less attractive. I believe it because I believe over 10 years the purchasing power of the US dollar declines by 75%, which is, sadly, very good for the nominal price of gold and silver. So I suspect we'll continue to have good years. If you try to measure the years that we have in the future, by 2025, you will almost by definition be disappointed. There are other people who probably have less speculative alternatives than I. And for them, they probably shouldn't sell their silver. I believe that the silver price is going to go up from here. Make no mistake. I also believe that I have a competitive advantage in silver stocks. And the silver stocks, the best of them, will exhibit more torque for silver. Because I've spent almost 60 years learning how to speculate in silver stocks, it makes perfect sense that I would sell my silver and buy silver stocks.
The market dynamics are shifting as generalist investors finally enter the space, evidenced by positive ETF inflows and silver beginning to outpace gold. However, the explosive coiled spring phase, where assets were drastically underpriced relative to fundamentals, has primarily played out, meaning future gains must now be earned strictly through the ongoing devaluation of the US dollar. Arithmetic analysis suggests the currency will lose approximately 75% of its purchasing power over the next decade, ensuring that gold's nominal rise is simply a mirror of this deterioration rather than a net appreciation. A dangerous psychological disconnect remains evident, as investors who ignored silver at $20 are now rushing in at $80, chasing price action rather than value. While the easy money generated by the initial valuation snapback has been made, the long-term trajectory remains locked to the inevitable erosion of fiat currency. Let's get back to the interview.
Well, the equities certainly have outpaced the metals last year, as one would have expected. What was unusual was that the normal progression, which is that the best of the best miners and the largest miners would move first, followed over sort of a 2-year time frame, eventually by the penny dreadfuls. What happened in 2025 is that the smallest and gamiest of the mining stocks moved too, in very dramatic fashion. The consequence of that is that we have an odd market. The metals moved, the best of the best moved, but not as far as we would have expected, and the rest moved much further than we would have expected. What that's meant for me, personally, was that in October, I sold 25% of my junior stock portfolio, my junior mining portfolio, because I felt that the sector was ahead of itself. I felt, too, that by selling off 25% of my upside, I could eliminate my downside, which seemed like a very good trade. It is a truism that you haven't made the money until you've taken the money. What's probably instructive is what I did with the proceeds. I took half the proceeds and I bought physical gold and a package of 3 senior gold stocks, Franco-Nevada, Wheaton, and Agnico Eagle, which is to say I didn't exit the sector. I just de-risked. I went to beta. Normally in a bull market, you would go from beta to alpha. But as I say, this market short-circuited beta and went straight to alpha. And so I de-risked. Much more recently, last week, I noticed that in my own portfolio, physical silver, which I'd bought on an average of $20 an ounce, had exceeded handily my target. I bought the stuff at 20 because it was hated. And you and I talked about this in an interview 4 or 5 years ago, the fact that silver was absolutely hated and a coiled spring. And I said to you that I thought that silver could handily take out its old nominal high at $50. Well, I was wrong. It took out 75 instead. The fact is that I bought the silver because I thought it was oversold and hated, and I thought it would recover. When my investment objectives were reached, I sold my silver, my physical silver, at least 80% of it. Now, there's a lot of people who are in place in silver, and for them, well, they have nothing to sell. What I have decided for me personally is that there's more torque left in the silver stocks, and I have a durable competitive advantage. For me, gold is a savings asset, and I haven't sold any of my gold. I've added to it. Silver is a speculative asset, and I'm a good speculator. So I decided to redeploy my physical silver assets into silver equities and oil and gas, which is to say I've used some of the outside strength that we've seen in the last 3 months to shift my risk focus down rather than up. The CPI is a construct rather than a measurement, which is to say it's an index that is assembled by the indexers. Among other things, the CPI doesn't include food or fuel when it's inconvenient. If you drive or enjoy lunch, the index is of limited utility to you. I would suggest that the Bureau of Labor Statistics, the people who populate the Bureau of Labor Statistics, don't shop, Dunnigan, where you or I or your listeners shop. A simple thought experiment where you look at the price of a basket of goods and services that you consumed in 2020, and you look at the price of that same basket of goods and services today, will tell you that the 2.5 or 2.6% estimate of the CPI is fiction at best. I believe that inflation, which I define as the deterioration of the purchasing power of the US dollar, is proceeding along at 8 or 9% compounded. Look at the price of gasoline over the last 5 years. Look at property tax. Look at health insurance. Look at groceries. Look at rents. Look at mortgages, which have doubled. Mortgage insurance, which has doubled. And explain to me how the deterioration of the US dollar, the purchasing power of the US dollar, has been at 2.5% compounded. Now, it's interesting that when I talk about the deterioration of the US dollar proceeding at sort of 8% compounded, it's interesting to note that if you look at the gold price in 2000, the year 2000, 25 years ago, and 2025, that the gold price increased by 9% compounded. I would suggest that the price of gold, the nominal price of gold, the US dollar price of gold, is over time a much better gauge of the deterioration of purchasing power than the US dollar, than the CPI. We talked before that the period 2000 to say 2023, mid-2023, was a period of time when the stage was set for gold, but gold didn't respond. What gold has done in the last 2.5 years is it made up for lost time. A much better measure of the performance of gold relative to the purchasing power of the US dollar is over a long period of time, which is to say the year 2000 to 2025, where I would suggest the real rate of deterioration of the US dollar was 5.5 or 6% compounded, and the rate of increase in the nominal quote in gold was 9% compounded. We learned in 2024 that the FDIC had something like 120 permits in application, and they approved 2. If you divide 120 by 2, you get 60. Frank Trotter and I are both in our 70s. We looked at each other and said, do we have 60 years to wait in order to be granted a charter? And the answer to that clearly was no. So we went out, we bought a little bank, Stearns Bank of Uppsala in particular. We bought it because the balance sheet was so easy to understand. We didn't want to buy somebody else's problem. When we went to the parent company and said, we're going to have to do substantial due diligence on the loans, they said, no, you're not. If you want, we'll buy all the loans from you and turn over cash. We don't suspect you'll need to do a lot of due diligence on cash. The answer to that was yes, that's right, we don't. So we are now bankers. We are serving to the best of our ability the community of Uppsala, Minnesota, a community that doesn't have as broad a banking needs as the country. And then we are applying our capital and our business infrastructure to that bank and taking it national. Right now, we are banking locally in Uppsala, and we are also using that charter for a few investors to accept gold and silver on deposit and lend against it. In other words, we're actively in that business now. We are also actively opening national accounts for existing shareholders like myself. You get one chance to make a good first impression. So we're using my money and Frank's money and other employees' money to make sure that when you make a deposit, it gets deposited. To make sure that when you buy euros, you get euros. When you buy gold, you get gold. When you write a check, it cashes. Once we've shaken the bank in on our own money, we will roll the bank out nationally to our waiting list. That will begin for all services February 17th. Right now, there are some limited services. You can open a checkbook IRA, which means you can establish an IRA that could own a duplex or a triplex or a franchise or private equity. We can do that for you right now. In certain circumstances, which is to say large accounts, we can make a gold or silver loan right now. But for the range of goods and services, for our money market accounts that pay interest and permit checking, for your ability to save in 20 currencies, foreign currency CDs, for services like that, the bank will be open for business beginning February 17th.
Faced with a regulatory backlog in which the FDIC approved only 2 of 120 bank charter applications in 2024, the decision was made to bypass the waiting list by acquiring an existing institution, Stearns Bank of Uppsala. This strategic acquisition allows for the immediate implementation of a new banking model focused on tangible assets and transparent liquidity. By purchasing the loan book for cash to eliminate legacy risks, the foundation has laid the foundation to take this local charter national without the burden of previous bad debts. The new entity is set to officially launch its full suite of services on February 17th, bridging the gap between traditional fiat banking and sound money principles. The platform will offer unique financial products, including the ability to hold deposits in 20 different currencies, open checkbook IRAs for private equity, and secure loans against physical gold and silver. This initiative represents a critical step toward restoring solvent banking, ensuring that depositors have access to liquid, diversified savings options free of the risks of standard fractional reserve banking. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.